Central banks. They sound boring, right? But let's dive a little deeper. Big, faceless institutions making decisions that seem a million miles away from our daily lives. Yet, these decisions are far more connected to us than we might think. But here's the thing. Those decisions, particularly about interest rates, have a ripple effect that impacts all of us. Whether you're a business owner, a homeowner, or just someone with a savings account, you're affected. Think of it like this. Imagine a stone thrown into a pond, creating ripples that spread far and wide. When central banks raise interest rates, it becomes more expensive to borrow money. This affects everything from mortgages to business loans. That means businesses might think twice about expanding, and people might put off that new car or home renovation. The economy slows down as a result. Demand cools down, and hopefully, so does inflation. It's a balancing act to keep the economy stable. Lower interest rates have the opposite effect. They make borrowing cheaper, encouraging spending and investment. This can boost economic growth, but also risks inflation if things get overheated. More spending can lead to higher prices. So, central banks have to carefully monitor and adjust rates to keep the economy on track. It's a delicate balance. So, when central banks like the Federal Reserve in the US, the Bank of Canada, and the European Central Bank make announcements, the whole world pays attention. Their words can influence global markets. Their decisions send signals about the health of the global economy and can move markets with incredible speed. It's a reminder of just how interconnected our world really is. In a move that surprised absolutely no one, the US Federal Reserve opted to keep interest rates unchanged at its latest meeting. This decision was in line with market expectations and reflects the central bank's cautious approach in the current economic climate. This pause in the Fed's aggressive rate hiking cycle was widely anticipated by economists and investors alike. Many had predicted that the Fed would take a breather to evaluate the effects of its previous rate increases on the economy. Inflation, while still above the Fed's target of 2%, has shown signs of cooling, giving policymakers some breathing room. The recent data suggests that the measures taken so far are starting to have the desired effect, though the journey is far from over. However, make no mistake, this is not a sign that the Fed is ready to declare victory over inflation just yet. The central bank remains vigilant and is prepared to act if inflationary pressures resurface. We're going to need to see further evidence that inflation is on a sustained downward path, Fed Chair Jerome Powell cautioned in his post-meeting press conference. He emphasized the importance of a consistent and long-term decline in inflation rates. The message is clear. The Fed is data-dependent. Every decision will be carefully weighed against the latest economic indicators to ensure the best possible outcome for the economy. Future rate decisions will hinge on incoming economic data, particularly on inflation and the labor market. The Fed will closely monitor these metrics to guide its policy actions. For now, though, it seems the Fed is content to sit tight and assess the impact of its previous rate hikes. This period of observation will be crucial in determining the next steps in their monetary policy strategy. North of the border, the Bank of Canada surprised markets with an unexpected decision. They slashed their benchmark interest rate by 1/4 percentage point, catching many off guard. This unexpected move came in response to growing concerns about the Canadian economy, which has been hit hard by slowing global growth and slumping commodity prices. Factories are empty, and the once thriving sectors are now facing significant challenges. The Canadian dollar, also known as the loonie, took a tumble on the news, falling sharply against the US dollar. This decline reflects the market's reaction to the rate cut and the broader economic uncertainties. The rate cut is intended to stimulate the economy by making it cheaper for businesses to borrow and invest. Lower borrowing costs could encourage companies to expand operations, hire more workers, and increase overall economic activity. However, it remains to be seen whether